Hello and welcome to the future. Yeah, you heard it right. Have you ever wondered where money goes when you deposit it in banks? It goes to the greedy banks and government. We have one central authority that controls all the cash flow, which makes it very difficult for a common man to know what happens with his money and can also limit what he does with his money. Plus, the banks charge a hefty amount of interest. Payday loans can go up to 500%. Credit cards can average up to 25%, and personal loan can cost you around 18% of your value. Decentralized finance, also known as DeFi, was introduced by Mike Ray McDonald and Fernando Martinelli so as to tackle this problem. There are no banks, but there are pieces of codes instead that run and act as a bank and have moderators like you and me with computers. They don't require you to trust them because they are literally just a piece of code and they will get executed no matter what happens, even if there's a war between Russia and USA. Okay. Also, if you're running a business, they can limit what you can do. For example, right now, if you have a little magical tree business, that maybe for medicinal purpose, they can even tell you not to bring in any of the money from that business to the bank, which seriously limits you. So basically, decentralized finance is built on three main things: the cryptography, the blockchain technology, and smart contracts. Let's dive into decentralized finance. Before we talk about what are stablecoins, first we need to know about decentralized finance, where the control is given to the people on the blocks and you can use it for a variety of activities. For example, DAI, Tether, and USD coin are all what we call stable coins. This is because their price is tied to the United States dollars. Your real world money can be converted to a form called stable coins, which can be traded in the network. Now you return the stable coin and get your currency back. Now let us talk about another pillar of DeFi, which is smart contracts. Lending and borrowing is a huge part of our current financial situation. It would make sense that the blockchain could do it better. One of the reasons we can reliably lend and borrow with banks is because we usually put something down like 20 collateral. So that if we never pay back the full loan, our government can come after us and throw us in jail or make us pay that money. In short, there are legal consequences for not paying a loan back. Well, with crypto, this is a problem because one of the pros of crypto is anonymity. You could put 20 down and run away with the rest of the loan and never be seen again in your life. So we have to find a way to solve this. In fact, with the use of smart contracts, we can actually allow others to use our funds while still keeping custody of them. So smart contracts are not that smart as their name suggests. They are just a piece of code having bunch of if else condition and get executed on their particular date and time. There's no human being that has to do the calculation or have to do the transaction. It's all automatic by the code. Let us take an example to understand more clearly. Say you have 10 Ethereum coins worth $1,000 because they are each worth $100, but you don't want to sell them because you greatly believe in the Ethereum project. So you put them up as collateral and borrow $800 worth of Tether, which is a stable coin pegged to the United States dollars. So you trade that $800 and you make some money, you lose some money, you make some more money. And now it's time to pay back your loan. So you have $850 in Tether and you pay back the original $800 loan to get back your 10 Ethereum. Well, in this little example, you made $50 from the little trades that you did and you got lucky. But it has also been a few months and Ethereum, like it has done in the past few months, exploded. Now they're worth $150 each. So now you have 10 Ethereum at $150 each. So now you control $1,500 plus the $50 you made trading basically. If you believe in Ethereum and you have it but you don't want to sell it and you don't want to use the value of it, you can take a loan out of it, hoping that it will be worth more whenever you cash it out. However, if you traded, you lost some money, you gained some money, and then you lost some more money. Maybe you ended up with $750 either. You would have two options. Option A is to front the extra $50 to pay back the full loan, the 800, to get back all of your collateral, and option B is to just keep your $750 and lose your 10 Ethereum, which could be worth a lot. Now this might be information overload, But quickly, there is a second type of loan in crypto called a flash loan, which is a loan that lasts for 10 seconds. If you could buy Ethereum for 10 on Coinbase and then sell it for 11 on Gemini, theoretically, you can make a dollar every time you did that. We have talked a lot about finance. Let's take a look on the mathematics involved in the blockchain and Bitcoin transactions. For blockchain, it turns out that it involves something called elliptic curves. So now we need to look at what these curves are. An elliptic curve is a set of points x comma y that satisfies the equation y squared equal to x cubed plus ax plus b for certain values of a and b, together with a point O, which is called the point at infinity. Now the elliptic curve used for blockchain is a specific one in which a equals 0 and b equals 7. In other words, y squared equal to x cubed plus 7. To calculate points on this curve, you just put in the values of x and figure out the corresponding values of y. For example, when x equal to 0, the equation becomes y squared equal to 0 cube plus 7, or y square equals to 0 plus 7. For solving y, we get the positive square root of 7 and the negative square root of 7, which gives us 2 points on an elliptic curve, 0 comma positive square root of 7 and 0 comma negative square root of 7. We can carry on finding many more points to produce a graph like this one shown here. Elliptic curve can even define a sum operation. This isn't like an ordinary addition, but is a way of combining 2 points. That's known as point addition. Say we have 2 points P and Q which lie on the elliptic curve, like those shown on the screen. We draw the line that joins these 2 points and extend it until it intersects the curve at a third point. Then we find the point that is symmetric to this in the x-axis. This is what we refer to as sum of P and Q. We can also use the curve to add P to itself to give P plus P or 2P. To do this, we can consider tangent line to the curve at P, extend this line until it intersects the curve at another point. The point that is symmetrical to this with respect to x-axis is 2P. So basically our goal is to obtain a cryptographic algorithm using the elliptic curve. For this we need a maths process that's easy to compute in one direction but hard to invert. The one we'll use is called the discrete logarithm. So what does that mean? Take a point P on the curve, then consider a large positive integer n and calculate q equals np. In other words, p added to itself n times. Knowing n and p, a computer can carry out this calculation very efficiently. On the other hand, starting from p and q, it's very difficult to calculate n. Similar to the logarithms you know, n is the logarithm to base p of q, the integer number n, such that np equals q. The security of elliptic curve cryptography is a consequence of the difficulty of computing discrete logarithms like this. It's important to note that elliptic curve cryptography, like fundamental maths of blockchain, doesn't deal with the field of real numbers. Instead, everything in it is related to what are known as finite fields and modular arithmetic. For the purposes of Bitcoin, in the blockchain, we work with the elliptic curve modulo the p that appears on the screen, and for these sum operation, the same formulas is used as would be working with the real number field. Securing hash algorithm or SHA-256 is a family of algorithms for securing your data and converting your data into hashes so that your data is private to you and it does not fall in bad hands. You can sleep well at night knowing your data is safe and encrypted. Even sniffing of the data packets cannot break the encryption, as these algorithms use elliptic curves to generate hashes and use all the different types of gates like XOR to encrypt your data into binary forms. In blockchain, there is also a concept of community verification, in which the community gives you the go for a financial transaction so that no fraud happens and you are not duped of your money. We have tried to create our own unique algorithm known as Shack's algorithm, which uses concept of graph theory and probability. Here you can see the diagram of a cluster. Our model consists of a head node and all other nodes connected to the head nodes are spaced separately in the memory. Now all these nodes combine to form a cluster and all these similar clusters form a very own blockchain network. Now a layer typically consists of 64 nodes. Now for our own original algorithm, we have a complex number which is stored in the head node. The public key is to maintain contact with other cluster and the private key to add another layer of security by adding the hash to the existing hash. We convert a text to hash and then pair up the text in pairs of 2 and perform the XOR operation to reduce the data size to half. And then we feed that binary number into a curve. And after that multiply the private key to the output number. The hash function we have selected is y squared minus 4x squared plus x powered 4 equal to 0. This is the diagram of the function we choose as our hash function. Addition of probability theory gives an additional layer of security to the user as we take the probabilities of going from one node to another and add it to the hash. Now each layer has a probability value associated with it, and this probability also gets added up to the hash that we have already received to take the security a notch above everyone else. Now after we have reached a block and stored the value in the block, it gets disconnected from all the other blocks and remains connected only with the head node. So when we need to verify the data, we need less computing time to find the value. Our algorithm can be applied to financial transactions where one cluster holds one wallet address and another wallet address is at another cluster. We verify the addresses and then verify the transaction. We have now come to an end of this paper, but this is just the beginning of a revolution in the finance world. As DeFi will open new horizons for this world, we try to create something original, though it might have lacked in some aspects, but we'll work on it in the future. Thank you very much.